hope you've had some lunch. I just grabbed some now. Was busy the whole morning. Was busy the whole morning selecting a location for a side event, which is a workout, which we're running on Thursday. So if any one of you are interested in doing a workout in a park, come up to me later. I'll tell you how to register. So here we're going to talk about a boring subject of payments. It's not as exciting as meme coins, as pump.fun, as all those things, but if we really go back to the vision, that was what crypto was about from the very beginning, if we look at Satoshi's white paper, right? And the question is, are we there yet? And if not, why not? And when we'll get there, enabling real on-chain payments in the real world. So the vision is and was and will be quite ambitious. So crypto as a technology, blockchain as a technology, allows for instant, cheap, borderless, transparent payments with potential to disrupt various industries from finance to gaming to e-commerce, and so far it's only been used mainly for trading. So what's standing in the way of mass adoption? It has been a bumpy road since crypto appeared, right? Mainly speculative use cases, not much application in the real world. Tech has historically been lagging behind the hype. A lot of talk about it, a lot of fundraisers, a lot of companies trying to work on something. Some of them not even trying, just raising money and running away with it. Even with the more established and well-intentioned products, there's been quite a lot of controversies, right? Most people remember how Tether was being accused of not having enough backing for collateral, and Terra UST collapsed, and USDC even had an issue a few years ago when it depegged, and the list goes on. What arguably changed the picture was the combination of increasing interest rates and the technological advancements that, in my view, that was kind of the game changer. So on the one hand, when interest rates started going up, it gave stablecoin projects a proper business model, not just a product market fit, but an actual business model when they could keep themselves alive and make a lot of money, like many of the projects. And then technological advancements allowed to enable this technology in the real world. When I'll give quite a few examples of Wirex because that's what we know best, what I know best. A lot of other companies are building in the space. We were one of the first ones, if not the first ones, to decide that crypto needs to be spendable in the real world, and that was in 2015. So there was no crypto, almost no crypto except Bitcoin. So the idea was Bitcoin needs to be a spendable currency. You need to be able to buy coffee with it. If you cannot, then it's not a currency, right? Because being a means of exchange is one of the fundamental features of money. But realistically, no one buys coffee with Bitcoin. So we learned kind of the easy way, the hard way. People either pay with fiat or with stable coins, because the reason for someone to hold Bitcoin as an asset is because you expect it to go up in value. If you expect it to go up in value, why would you spend it? So lately, over the last 2-3 years, we've seen massive developments in the space, both from regulatory perspective and from technological perspective. So back when we started, it was not possible, not only to mention that we're working with Visa, it was impossible to have any mention of it, right? When we launched the first card, we literally had to remove every single mention of Bitcoin from the website when we knew that Visa would be looking at it to approve or not approve the co-branded card program. And now, not only Visa, MasterCard have their own crypto divisions, major acquirers are starting to process stablecoins directly. The biggest news over the last few months was the acquisition of Bridge, a 2-year-old company dealing with stablecoin infrastructure, got acquired for over $1 billion, and that made a big news, and everyone is now looking into and talking about stable coins and their applications in the real world. Technology has advanced, so it's a lot faster now, it's a lot cheaper to run those transactions, whereas in the early days it would be impossible or impractical to try and process payments in the real world, waiting for 10 minutes for a transaction to confirm and paying a few dollars, if not tens of dollars, for a small transaction to happen. That's not the case anymore with fast L2s and L1s. Regulatory momentum has been catching up. This year is being called the year of stable coins, and just from a broader perspective, more and more crypto companies are acquiring traditional companies, and traditional companies are acquiring crypto companies, and the likes of Coinbase, Circle, Paxos, BitGo are talking about becoming banks, not just public companies, but banks. And there's finally is a surge in real world use cases and adoption. So this number, over 27 trillion transacted in 2024 in stablecoin volumes. That's not coming from Tether, that's not coming from CoinMarketCap, that's from a Visa report. So Visa themselves are acknowledging that stablecoin volumes is starting to exceed volumes of Visa and MasterCard themselves, which were and still are the undisputed leaders in the payment space. What are the real world use cases? So far it's mainly been around hedging and exchange at best, right? So you hold a stable coin because it's a faster way to go in and out of Bitcoin or Solana, Ethereum, whatever. You just hold it on an exchange, and that has been 90+% of all the use cases. But now with the combination of improving technology and improving regulatory environment, you can use stablecoins for cross-border payments, remittances, treasury management, payroll, especially for companies that have distributed workforce where it's either impossible or impractical to pay in dollars, people waiting days and paying high fees along the way. And of course, financial inclusion. It's all good as in the first world to be talking about what is good, what is not so good, but people who are deprived of the basic necessities of access to financial services in the real world, they tend to adopt stablecoins much faster, very fast indeed. Like an example we could see recently when the war broke out in between Russia and Ukraine, a lot of people had to leave their countries and got deprived of access to banking systems wherever they go. So everyone, including like not technically savvy people, but anyone like a blogger on Instagram very quickly learned how to use USDT, USDC, whatever to exchange P2P and then exchange it into a local currency wherever they are. So in less privileged societies, the use cases are finding themselves faster than elsewhere. But it's still not ideal. Still, the UI UX is quite complex, so you can expect someone who doesn't have access to banking to learn how to use P2P transactions and deal with stablecoins and with exchanges, but you can't expect an average person to be motivated enough to do so until and unless the UI UX improves and becomes very easy. Transaction fees can still be sometimes quite high. Regulatory uncertainty is still there. Some countries are more advanced, some are less. In many places it's still in a gray zone. Real-world usability is still quite limited, so whereas it's very easy to transfer stablecoins from one location to another, you don't even have to think about location, right? It happens in the cloud. But then going into stablecoins or out of them into or from real money is still not obvious in many cases. And last but not least, trust concerns. Too many ill-minded players in this space, and how do you know who you can trust and who you cannot trust? What we need to bridge that gap and to solve those problems. So firstly, the integration with traditional financial systems and services need to be seamless. It needs to be easy, fast, and cheap. You don't have to pay percentages or sometimes tens of percentage points to be able to move your funds between crypto and fiat. Transactions need to be gasless, because otherwise, why would you pay someone with a card or via bank transfer when on top of that amount you need to pay something extra? There's just, unless you're a real advocate of the technology, you're unlikely to do so. Ideally, it needs to be linked to existing world payment rails and products. So a card, like in case of Wirex, for example, that was the idea from the beginning. Give people something familiar rather than go and try and convince every single merchant to start accepting cryptocurrency directly. That's starting to happen 10 years from then, but still it's not very easy. Not by far, not everyone will accept stable coins or cryptocurrency directly. Ideally, it needs to be self-custodial. We still see that 95, maybe more % of people don't care about self-custody, despite all the bad events that happened in the industry, just because it's more convenient to work with custodial applications, and it's easier for companies offering custodial type of service to monetize such customers, so that the majority of usage is still there, but it now can be fully self-custodial, and it probably should be. And then, yeah, it needs to be easy and appealing enough to use, so not just the UI UX need to improve, but also it's about incentives you need to give to people, because unless you're really, really motivated and you have no other means of making a payment, you will probably not be very likely to move unless you give some, you get some bonuses. People are spoiled by bonuses these days. So what a few companies have been building lately, Gnosis Pay is one of the examples, Kuripa is another example, Wirex is arguably the most advanced one out of them, is payment infrastructure in the real world that's linked to the on-chain world. So we back in it with 10 years of experience. The first card we issued, as I mentioned, was a Bitcoin card, not even crypto card, because Ethereum didn't yet exist. It can now be fully self-custodial, linked to account abstraction wallet. So you, as a user, you connect your external wallet on one side, and on the other side it's linked to your card, to your IBAN, to your other real-world payment instruments. In our case, it's running on Polygon ZK rollup with some other propositions out there. People want you to use their own chains sometimes, of their own stable coins. We try to maintain it as open as possible. Transactions are gasless, so once your funds are on this roll-up, there's no more gas to pay. So when you tap a card, you get charged that amount. You don't have to pay gas on top of it, and then moving funds back to another chain is gasless as well. And it's obviously accepted everywhere Visa is accepted, and you can also get rewarded for making these payments. So the way it works, let's say I have some stable coins or crypto now. The way it works now, I have to, and let's say I'm a very advanced user, I know how to use a self-custodial wallet, right? So I need to execute a transaction to send my funds to a crypto exchange, to a centralized exchange in most cases, because decentralized exchanges don't have real cheap, fast on and off ramps yet. Then so I exchange there, then I off-ramp, which implies sending it to a bank. And a bank, in many cases, will ask questions. Where is it coming from? Most banks don't know how to deal with source of funds in crypto, so they, in the best case, it can be delayed. In the worst case, it can lead to your account being closed. And only then, once your money is there, after you've paid some fees and waited for a few days and were kept in the black through this whole time, because SWIFT, for example, well, SEPA, faster payments, other PIX in Brazil, those are all instant settlement systems, but SWIFT, the cross-border ones, still can take up to 5 days, and there's zero transparency throughout the process. And then you're able to spend it in the real world. The way it can and already works in case of Wirex Pay solution or a few others, your wallet and you spend it. That's it. You tap the card, an on-chain transaction happens at the same time. Your funds get debited from your wallet. the card provider, ourselves in this case, we don't have a touch your funds, would never take custody of it, so it's a fully non-custodial offering. It's not even subject to regulations like MiCA because there is no custody. And even the settlement itself with Visa happens in USDC afterwards. So that's a relatively new thing. Visa is piloting this technology with like 10 companies around the world, Wirex being one of them. So the difference is quite stark. How it works. So a user has a wallet which they connect to the DApp, and there they get an account abstraction, a smart contract wallet created. So the user controls the keys at all times. The user grants the smart contract the permission to spend, let's say, 500 euros a day or a certain amount per transaction. And that's it. Once that permission is granted, the tapping or swiping of the card leads to an event, an on-chain event happening where funds are being deposited. And then through that account abstraction, it's linked to all the real-world payment rails, Visa, MasterCard, banking rails, etc. So the slow and costly off-ramp problem is solved by instant real-world card payment and settlement globally. Custody risks are removed because you, as a user, remain in full control of the funds. So let's say something goes wrong. Let's say I went out and bought some weapons or drugs online and my account needs to be blocked. My card can be blocked. I mean, I will be prevented from making further card transactions, but my funds remain in my wallet because I keep the keys. So the card issuer has no access to the funds. And stable coins in this case can be instantly spent directly anywhere. There's no problem making Ethereum or other EVM assets spendable, but it's arguably not a very appealing case because people don't tend to spend a volatile cryptocurrency. They tend to spend either stable coins or fiat. Who can benefit from these technologies? So apart from end users, obviously, any Web3 wallet can integrate this technology and offer it to their own users. And it doesn't have to be a licensed financial institution because it's fully non-custodial. There's pretty much, well, no one knows what will happen 3-5 years from now, but for now this is outside the scope of regulation. Neobanks, so existing fiat providers, they can start offering crypto functionality to their users pretty easily. Businesses can set up corporate accounts and issue corporate cards to their employees, especially if it's a Web3 business. It's still very difficult for crypto companies to get bank accounts. And even if they can, all those steps from one of the previous slides are there, but here you can, as a business, you can issue corporate cards to your employees, receive payments from your clients, for example, in crypto, and they pay salaries in euros or vice versa, right? Anything is possible. The move of funds between on-chain crypto wallet and bank accounts or cards or real-world payments is instant. DAOs can pay contributors in crypto, and the actual DAO treasury wallet can be linked to those cards, and each card can have individual limits. And yeah, various kinds of developers can produce any functionality that there is. You can enable an on-chain credit card, for example, link it to a protocol. The card itself doesn't care where the stable coin is coming from, right? It can be coming from interest from your collateralized position, for example. Cards can be branded to the wallets or DEX's DApp's own interface. And going back to the question, are we there yet with real-world on-chain payments? It's still not Web 2 type of experience. It's getting there, but it's very, very close to being there. So Wirex Pay is one of those solutions, as well as a number of other companies that are working on similar projects. So we're not there 100% yet, but it's underway and it's happening now. And last not least, this is sending you back to the original white paper. It's easy to forget working in this industry what it was and is about, right? It's not about yet another meme coin. Like when people say that pump.fun is good because it brings users on chain, is it really? You were brought on chain and you lost all your money? I would argue not. But when you can start making payments in the real world, so find like real world utility for your crypto assets, I think that's what is hopefully going to drive adoption in the right direction. That's it for the talk. Open for questions.
Hi. Okay. Hi, I'm the architect of the national stablecoin over here. So I'd like to further discuss some details with you. But first question here, when most of the people are mention stablecoin, they typically think about USDT, USDC basically. We can also see it in your presentation right now. And then you mentioned the case of, I don't know, Ukraine or something, the people were, you know, it was easier to onboard the people because there was like the emergent need to step into the crypto space, basically. But did they adopt the dollar-based stablecoins, or did they adopt the local stablecoins? Like in this case, I think that would be hryvnia, I guess, right, in Ukraine?
I think, if talking about Ukraine, I think there is a project with digital hryvnia. I'm not entirely aware, but the regional stablecoins is a growing trend. Dollar still dominates with 95, maybe 99% market share, but we see the likes of Singapore dollar, Brazilian real, Turkish lira. Yeah, those are the first ones that come to mind, but there are more. Well, euro stablecoins are also catching up, despite being pulled back by regulation. It will be growing, and in our case, we're not limited to USDC, USDT. So right now, we've got USDC, USDT, and DAI, which covers arguably 97% of cases, but nothing stops us from adding other stablecoins as well, and we already are, and we'll keep doing that.